Hi, this is James in with Full Capital, and I got Shameer here with Patel Law Group. Shameer, what is going on, man?
All right, man. Good to see you again.
Well, thank you for coming on. I know, we're in the midst of a lot of different things, right? So, a lot of people are going through, workouts. They're going through stuff with their lenders. They're going through stuff with their equity, and then some people are out there trying to get deals done, right? So,
Yeah,
trying to buy deals, and so you're in the middle of all that. So that's why I want to bring you
yeah,
on and just talk about what you're seeing out there because a lot of
yeah,
times we see some stuff. We look more at T12 financials, rent roll, that type of stuff. We're trying to get people to a refinance number, but you're sort of on the other side of whenever I say, "Hey, go talk to your attorney," then they call you. So that's why this is perfect. So maybe let's start with guys who are in deals now.
yeah,
What are you seeing? What are they having to do right now? Like, what are you working
yeah,
on? Yeah.
yeah. So I feel like deals right now, people, we've seen a handful of folks that are feeling a little better about their refis than they did 6 months ago.
Yeah, it's 50 basis
Um,
points lower. So
yeah,
yeah, everyone feels a little bit better,
they
right?
feel a little better. So,
It was 5 million, now it's like 2.5, so it feels better. Yeah.
yeah, we're going from like putting in $1 million to putting in like $250,000.
Yeah,
It's,
yeah.
so um, there's a little bit of like wait and see kind of does this continue to slide, and does that mean not only do the reference rates come down but also potentially spreads come down,
Maybe.
so that we see a little bit of like pray, was this just like wait and pray type stuff.
Okay. Okay.
um
So then are those people just doing like extensions? Like they're just going
yes,
back to the
yeah,
lender and saying, "Hey, rates are going to be like 4% in 12 months.
yeah,
So, just give me 12 months and I'll be out. I'll be able to refi. I'll be able to sell
yeah.
this
So we're
deal."
having a
Okay.
lot of that exact conversation of like,
Okay.
should we do we negotiate with our current lender to do rate cap, purchase a new rate cap,
Yeah.
try and, we'll work with them a little bit on like, how wide that cap is.
Like
Maybe
a
we
higher
work with them
strike.
on like,
Yeah, higher
yeah,
strike and just yeah.
duration of term. Do
Okay.
we do 2 6 months? Do we try and get a little better than that? Um, Maybe, they haven't hit a certain DSCR step or
Sure.
debt yield step, and um, there's some sort of additional pay down necessary. How do we negotiate through that additional pay down? Is it, material? Is it significant? Is it not? Is there a way to potentially amortize that additional pay down to get to those steps? Do you
Okay.
potentially get them waived? So that's kind of the math we're going through. But then now that we're starting to see a downward trend, potentially, hopefully,
On
on
rates.
rates.
Yeah.
We to that entire mix, we add, or maybe we just go refi.
Yeah. Yeah, yeah.
Um,
Okay.
and so that's kind of the conversation that's ongoing around essentially our 2021 deals, right? Because
Yeah,
they're all hitting
that's right. Yeah, yeah. The
that 3 year
maturities
mark.
are right now. Yeah, it's
Mhm.
maturities are next 3 months,
Right.
for a lot of these guys. Okay.
And we're starting to have a little bit of that conversation around our like Q1, Q2 2022
2
deals
deals. Yeah,
that
yeah,
are
yeah.
now starting to think about, well, 6 months out, like, what are we going to do? What's the plan? If we need to raise more equity, you got to start that process early. If we need to refinance, we got to start thinking through property condition, and if we're going to go to agency, there's going to be an inspection, and are we ready for that inspection? So you know it's never too early to be thinking about your next move,
Right.
and prepping for it, and that's kind of the conversations we're having now that we're getting into that meat of that 2021-2022 acquisition boom, and the bridge loans that arose out of that.
Yeah, this is, I think people were calling the peak probably late Q1 2022. So, yeah, we're right around that time where,
Yeah.
there was a lot of deals that closed in 21, but it was definitely more back-end loaded, sort of Q3, Q4 of that year.
Well, it was
So,
really like when if you think about when rates started to climb,
yeah,
um, it was kind of that Q2, Q3
22.
22
Right.
that you started to see, like, you're like, oh crap, this is not great. Like, we're starting to do some stuff that's not optimal. We're not, but we're trying to, reserve instead of buy a rate cap,
Yeah.
for that brief quarter or whatever, couple of months that we did that. Um, so those are the deals that are going to come up kind of in first half next year, and I think that's what we're starting to think through is like, what do those look like, and how do we plan for those
Okay.
when those start to hit?
Yeah, and I mean, like for guys who, all right, maybe they don't have that many problems right now. They're just, maybe they had agency
Yeah.
and they didn't really buy that many deals in 21 and 22. And now they're like, hey, I get it. Pricing's reset. Now I'm gonna go out there and buy. It's like what we were talking about. It's a
Yeah.
buyer's market. It's time to go,
Yeah.
right? Like
Yeah.
all the big guys, Blackstone, KKR, Equity
Yeah.
Residential, all these guys are buying billion-dollar portfolios. And me as a normal syndicator here, I'm gonna go buy a deal. What are you seeing? What are you
Yeah.
seeing
Yeah. It's
on
an
sort of the
interesting time,
PSA
right?
front?
Because
Yeah.
I think that the levers, the input levers have shifted a little bit.
Okay.
So, sure, I think we're starting to see some like uh shrinkage of the bid ask spread on the
Okay.
purchase side.
Yep.
Um, but with that comes also a shrinkage of the Main Street equity pool.
Mm,
So, sure, pricing comes down a little bit, but there's substantially less money out there
mm.
at like the 50K, 75K, 100K range.
Investors. Sure.
Our clients that would raise all of their equity in a day or two are now taking a couple of weeks, and they're having to work a lot harder to get that equity raised, right? So, and with that comes uncertainty. That comes, hey, we're not going to do hard money anymore. There comes, I need a little bit of a longer inspection period. I need a bit of a longer closing extension or two. So what's happening is we're starting to see PSA terms on our end evolve to account for these additional risks and these
Mhm.
additional market factors that we weren't really stressing about a couple of years ago.
Yeah, in
And
21, it was like, all right, hard money, $500,000. I'll close
yeah,
in 45 days, and then no contingencies.
yeah,
Yeah,
hard money, day one,
yeah,
pass through,
yeah,
get to the end of feasibility. I'll give you another 100K, no problem.
yeah,
Get to the end of closing. If I need another 15 or 30 days, here's another $500,000. You can just disperse it right away.
yeah,
Nobody's looking at how the property's performing.
yeah,
It's just it's all gas, no brakes.
yeah,
Um, right now, there's a lot more of a measured approach,
right.
and people are looking more closely at where are we at on occupancy, what is the potential risk during the contract period on occupancy, what is the potential risk on collections during the contract period. um
So
so
you're
we are,
seeing all those stipulations in there, like,
yeah, like,
yeah, I'm gonna put up 50,000, but if your collections drop below X,
correct.
if occupancy drops below, I can't get
Yeah, it's really
agency. Like,
occupancy. Yeah, so it's really
yeah,
like that 90% occupancy
90%,
threshold on
sure.
the agency side
Yeah,
is kind of the bright line test. And once you drop materially below that, like, it becomes really hard to transact on a deal,
yeah,
because
yeah, yeah.
agencies are going to adjust back down how much
Well,
they
you
lend.
can't. Well, they
Yeah.
won't. They won't lend on it. So then you got to go bridge, and all of a sudden you're at 8% versus 5, and
Yeah.
yeah, I just can't, and I can't raise the money, and so it just becomes a lot more challenging.
Yeah.
Um, yeah,
Yeah.
what's hard is like you don't like in 21, 22, people were at like literally like 98% occupancy, and they had a wait list, right?
Right.
Because
And
like,
without trying, like with mediocre management, where nobody really cared. Like, you weren't seeing management companies getting fired in
yeah,
21 and 22
yeah,
because everything was just like up and to the right.
it's 20%
And
rent growth, and yeah,
yeah, like we're like renewing at like 7 to 10%. I'm like, this is incredible.
yeah,
Um, last year we saw a spate of like, hey Shameer, I need to terminate my management company.
okay.
How do I do
Work through
that?
work through
So we
that, yeah.
saw, that's like the low hanging fruit on if you need to make a change is let's make a move on management. So we saw a bunch of that last year, and this year we're seeing a lot more like, hey, we want to do this deal, we like the deal, but there's a lot of contingencies here. We want to make sure it's really tight, and if the market starts to shake a little, then we want the ability to get out of this thing because
Mm,
everybody's worried that like we're going to wake up one morning and the bottom's going to fall out.
Yeah.
And how do we kind of contingent for that, to
So
prevent that from
so
happening?
I so usually so we jumped straight into this interview, and I did not give, and for my for me also, give people your background. Like, when
Oh
did you
yeah,
talk into
I
this
feel like we do
space?
this all the time. So and I feel like we know everybody. And so, my name's Shameer Soni. I'm managing partner at Patel Law Group. I run our multifamily practice. We're a full service law firm, which means that I run the real estate side. I run the transactional purchase agreement. I run the strategy on how we're going to run the purchase of the sale. I run strategy on debt and how we're going to most efficiently work through some of the issues on a transaction. Run strategy on title and how to solve through some of those issues. I have a partner in my office who runs our securities practice, which is private placement memoranda, 506B, 506C, all the fun, acronyms and alphabet soup you hear about in the SEC side. Um, our team consists of 5 attorneys. Obviously, I've been doing this a long time and worked with James extensively, the O Capital team, and just about everybody else in town. My colleague Scott, who's an associate, used to work at Arbor, so he's very well versed on the debt side. And then Chris, who runs our securities practice, has been doing that over 20 years. So we've got this really veteran, well-rounded team with deep expertise in the space, which has been particularly relevant now that every deal is not just copy paste. There's a lot more thinking to be done.
So, okay, so on the buyer side, you're seeing those people just sort of limp in with a little bit of money, 50, 100,000,
Yeah,
or they put in a little
hundred
bit
thousand,
more.
100,000's on a good day, man.
Okay, okay, 50,000, and it's got all these contingencies. And then, okay, so what are you seeing from the seller side? Like, what is making people go right now? Like,
Yeah,
what's usually the motivation on the seller side?
yeah. So I think the sell side, I think there's some sellers who've owned the property a long time.
Sure. Yeah.
Guys that weren't syndicators that bought the
Yeah.
property before 2021.
Right. Yeah. Yeah.
Guys that have held since 15 and 16 and
Yeah.
17. And for them, even though we've seen a dip in values, they're still significantly up.
Oh, sure.
And they're getting to the point where they want to retire. They have a change in lifestyle. The kids don't want to deal with it. They want to sell. And you see guys who want to sell and buy something better. Hey, look,
Right.
I've got this gain. I have the ability to now buy these newer properties at a more competitive price.
Right.
This the delta for me to get from here to this better asset is less right now, and so let me get out of what I'm in right now and let me get to something better.
Okay.
So that's certainly been a story we've heard pretty extensively on sellers right now.
Right.
To the extent we see some syndicated sellers selling.
Right.
It's typically pre 2021, or if it's 2021 and later, it's property that's troubled.
Right.
They're barely covering their debts or their debt
Yeah.
when they sell, and the equity is immensely impaired.
What
Uh,
is so in those situations when you're seeing lenders go back for the extension, what are these lenders making the borrower do to get that extension?
yeah. So look, the lender extension game is interesting because it's a bit of a game of chicken, right? Like,
Right.
as a borrower, you're kind of playing this game with the lender of like, hey, you really don't want to foreclose on the asset.
Right.
And the borrower is like, hey, and the lender's like, hey, borrower, you don't want to lose the asset, but we're kind of just staring at each other with like guns pointing at each other, and nobody's really wants to pull
Yeah.
the trigger.
Yeah.
So a lot of it comes with just experience. Like we've seen, we deal with a spate of different lenders in this space. We talk to lenders council all the time on different deals that do different stuff.
Right.
And I think that there are some lenders that are more uh, cognizant, concerned, about the reputational risk that comes with foreclosing on assets.
Okay.
And there are
Yeah.
other lenders that are not,
Mm.
and that are just like, you know what, we'll take it. We don't really care.
Yeah.
And then some of it's also market driven. Like I feel like Houston is somewhat more troubled than Dallas is. I think lenders are more willing to be aggressive in Dallas than they are in Houston, because I think Houston's seen as an inferior market for the time being.
Right. Yeah.
Uh, So there's a lot of like micro and macro factors. You know, we will always in the initial conversation be like, hey guys, you really don't want this back.
Yeah.
And kind of see what they say. And you know, we've had conversations where we're like, look, you don't want this back. And they're like, well, we've had 3 BOVs and we think it's worth blah blah blah.
Then
And
you're
I'm
like, oh, okay.
like, be my guest. If you can get that, like if you can get that money, be my guest. Have a good
Yeah.
time.
Yeah.
Um, but yeah, we see typically like lenders are somewhat realistic. They do understand that like, you know, even if you receive a BOV, there's a difference between a BOV and what it sells for.
Close. Yeah. What is close is that?
Um, and there's transactional there's reputational risk that comes with that. Like you take an asset, the next cycle, let you know your borrowers are going to be like, these guys are kind of jerks to deal with last cycle,
Yeah.
and
Like,
assuming they're not the only kind of player in the market, you know they're going to be less willing to do deals with you. So, um, we do see a little bit of that, and we try to play that game somewhat.
yeah. I mean,
Um,
we've seen lenders really focus in on, all right, you got to pay the extension fee. You've got to pay the interest rate cap.
Fees are not negotiable. That's how they make their money.
Yeah.
Like we're not negotiating with you on our attorney's fees. We're not
Yeah.
negotiating with you on extension fees. Like if you want to talk about some term type
Yeah.
stuff,
Yeah.
we'll talk to you about that. But we're
Okay.
not changing the amount of money we're receiving from you right
Yeah,
now.
yeah, yeah, yeah. Oh, yeah, your interest rate. We're not changing the interest rate.
Yeah,
Yeah,
that
you
doesn't
keep
change
paying the
either.
interest rate. Yeah, yeah. But
Really, the flexibility is on steps, right? It's on, you know,
the
if
debt
there's a
service
DR
hurdle.
threshold or a debt yield threshold,
Okay,
they'll work with you on that, assuming it's not like a crazy work with, you know, a crazy term. Um, you know, we've tried to work with them a little bit on like, you know, one of the big issues already on DSCR was whether the cap contribution is calculated in the DSCR.
of course.
That
Because
was a hot
is
topic.
any deal covering, right? At
Yeah.
SOFR plus 4? Like, no deal SOFR
And
plus 3,
that's
no deal
always been our
covers.
argument. I'm like, this
Yeah,
is impossible to cover.
yeah,
And some, you know, most lenders are willing to hear that.
right.
There's some that aren't.
Okay, yeah,
And you have to push them harder and get to the right people to have like an adult conversation.
yeah.
Um, so that's been kind of an area of focus for us because that really does affect all of our clients materially, right? Like every deal basically is not covering unless you include cap contribution.
So, so when do people, like, if people don't work with you now, when is the ideal time to reach out to you guys?
Um, before you get a demand letter,
Okay.
um, you know, ideally, like we work with clients, like we're working with clients when we start the extension process. So
Okay.
they're thinking through like, okay, we're in our notice period, we're 120 or 150 days out. Where are we at on on our DSCR, debt yield, whatever the testing is?
Okay.
How are we doing? And do we need like what conversations are we going to have with the lender? And
Right.
how have those conversations gone in the past? Because some of our folks have great relationships with their lenders, and it's an easy conversation of like, hey, look, this property is doing great. We need the cap contribution, yes, but fundamentally, this property is doing really well.
Right.
Um, so a lot of it's kind of subjective. Like you've got to understand and be proactive with where you are in the loan process. That's fundamentally what it comes down to.
Okay.
Kind of got to know yourself and kind of know the relationship. Um, but we like to get involved. We like to kind of get our advice in. Typically, our clients are like, "Hey, we're working with this lender or that lender," and we can tell them, "Hey, we worked with them in the past, and here's what we were able to achieve,
Yeah.
or what you should ask for."
Yeah,
And that,
I think that's where the value comes in, is this,
yeah,
that you've seen enough transactions and you've been through enough, whereas usually, I mean, some people bought 5 deals in 2021, but most people bought 1 or 2 deals.
mhm,
And those 2 deals might be with 2 different lenders. And
mhm.
so you're having to talk through these scenarios with new people. Those people might be at the firm for a year as an asset manager, and so like you just don't know who you're gonna be working with at some point.
Usually the trick is to get past the guy that's been there a year. Get to his boss. He's usually been there longer.
Find who's ever been there the longest, who can make a decision on this deal,
Yeah,
right? Yeah.
yeah. Give me the old guy sitting in the corner with the briefcase. That's the guy you want. Yeah, yeah. The first year asset manager is just Yeah, that's not the person.
So, I mean, so you've done plenty of agency, you've done plenty of bridge stuff. Have you, I mean, like when I was at GE, we did a bunch of CMBS and that was sort of
Mhm.
hot, sort of '06, '07, and it sort of has been on the back burner for a while now. And
Yeah.
I mean, I've heard some rumblings of it coming back this year,
Yeah.
but what have you guys dealt with the CMBS stuff at all or
So we have a pretty active hotel practice that my
okay,
partner Nish runs.
yeah,
He's been doing it for decade plus.
okay,
Um, and so we do a bunch of CMBS in that space.
okay,
There's been kind of conversation around like will CMBS be back on the multi side, which
yeah,
kind of bridge is essentially CMBS to some extent,
yeah,
similar terms. But one of the big things on the CMBS side is the way that they calculate net income, and some of the steps are a little easier to hit on the CMBS side.
yeah, they're more
Um,
flexible, right? So
yeah,
it's
you
it's
can
a
do anything.
stabilized product, but they're a little bit more flexible on maybe you don't have the net worth liquidity, maybe you don't have, a perfect track record, maybe your property's at 85 instead of 90, but they're gonna charge you for
Yeah,
it.
yeah, yeah. They're
Yeah.
going to charge you for it, and there's an ongoing kind of compliance expense that comes with that.
Okay.
Um, we've seen some deals that we've been involved with
Right.
have a CMBS or life co components, but life co is another option.
Yeah.
Um, we haven't done them in house, but we've had a lot of conversation with some debt shops for capital, but other folks too
Yeah.
that have raised the possibility of CMBS,
CMBS.
particularly
Okay.
on larger deals, right? So
Yeah.
one of the other things we've seen, kind of as a function of market right now, is that we're doing less 50 to $70 million deals and
Sure.
more $10 to $15 million deals. That's kind of the sweet spot.
Okay. Yeah.
Um, and so, back in like 21 and 22, when we are just cranking through
Yeah.
massive transactions on bridge loans, you know, you had to go bridge because our clients weren't really looking at agency back then.
Right. Yeah. Yeah.
Now,
Yeah.
agency deals are the only way they really are optimal is in that sub $25 million space, unless you get to like Freddie and have to do some more kind of gymnastics to make it work.
Right. Yeah. Okay. All right. Well, what is I know you guys will be at the conference here in
We
October.
will. We're
Uh
excited.
yeah, so you'll be up there trading some shots with some of the lenders on the panel. And so the what's the best way if someone sees this beforehand, what's the best way for people to reach out to
Yeah.
you, just get more information or reach out just on
Yeah, absolutely. So
deals?
patellegal.com, PATELLEGAL.com, easiest way to find me. As I said, as James said, we'll be at the conference this year. We unfortunately have had conflicts between our firm's charity golf tournament and the conference for a couple of years, so we're excited to actually be there this year and be able to attend and participate and watch all the great things that y'all's team does, and then we're super excited about it. Can't wait to hang out with our clients, and I'm sure we'll hear a lot of fun stories while we're doing that too.
Oh yeah.
Um, and I'm sure we'll have more content to share next time we chat with you.
All
More
right.
war stories.
Yeah, more war stories. Well, Shamir, thank you for coming on, and I'll see you in October.
Absolutely. Thank
All
you
right.
guys for seeing everybody done.
All right. See.
Thanks.